Portugal has bought itself a bit of breathing space by carrying out a swap of some of its government bonds. They were due to be paid back next year, which would have been difficult for Lisbon to do. Instead, it has exchanged those bonds for ones which will mature in 2015. That gives more time for Lisbon to make the cuts necessary to reduce its debt and hopefully get the economy growing again. Mr. Trader pointed out it's a first step towards the country returning to financing normality. He said the fact that more than a third of the investors holding these bonds took part in the swap shows that they're content to assume the risk of holding Portuguese debt for 2 more years. And that's seen as a positive for Portugal's return to the bond market. Portugal's not been able to borrow on the bond markets to service its government debt since it had to ask the EU and the IMF for a €78 billion bailout in April last year. Portuguese banks, insurers and pension funds are the main holders of the country's debt, with international investors still shying away.